Today, I'm sharing the most powerful risk management techniques I've learned over nearly 8 years in the markets. By the end of this video, you'll walk away with game-changing insights on how and when to apply risk and choose the most appropriate risk style to tackle your trades. I'm going to break down everything into clear, actionable steps. So stay tuned, because I'll be showing you not just the basics, but advanced strategies that top traders use to stay profitable. Let's dive in and level up your trading skills. To keep things simple, we're going to explore 3 styles you can choose from when managing your risk. Number 1, a fixed dollar amount. This is simply risking the same amount on each trade within a given time period. For instance, you can say to yourself that this month, I'm going to risk $100 per trade for each trade I take, and not deviate from this amount no matter the setup. The pros of this style are consistency, the fact that it's easy to track, and that it has predictable drawdowns. When you lose, you'll set back a predefined amount that's not too damaging. The cons of this style are that it lacks flexibility. It also doesn't scale with account growth, so you'll have to manually adjust risk as you go, and that it's not adaptive to market conditions. Number 2, a fixed percentage of your total capital. This means you take your liquid net worth and apply a single percentage allowance to each of your trades. For instance, if you have 10K and you want to risk 1% per trade, that's $100 per trade. But bear in mind, this is a percentage of your total capital, not just what's on the exchange. You should be utilizing leverage to keep just the bare minimum on there to trade. The pros of this approach are that it's proportional, you lose less with bad performance and win more with good performance. It's more suitable to long-term growth, and it keeps you in the game longer, as the reduced risk during losing streaks can prevent you blowing out an account. The cons of this approach are, again, it lacks flexibility if that A-star setup comes along. Risk can be harder to calculate, and again, it's not adaptive to market conditions. Number 3, a variable dollar or percentage amount within a risk window. This is my personal preference, as it allows you to be more fluid and really capitalize on top tier setups when they present themselves. All trades should be minimum 9 out of 10 scoring setups, but this can then be graded into 5 scales, creating a risk window of say 100 to 200 between 9 and 10. This is what it would look like in practice. A 9 out of 10 scoring trade would mean $100 risk. A 9.25 out of 10 would be $125, a 9.5 out of 10, $150, 9.75 out of 10, $175, and a 10 out of 10 being $200. This is an example of variable risk within dollar amounts, but could easily be applied to the percentage side of things by applying between 1 to 5% per trade. I'm sure you're looking at this wondering why you're operating within such a small range of rating, but although this may feel tight, realize that what you're doing by skipping the 8s, 7s, 6s, 5s, and lower is keeping yourself out of suboptimal positions. Whether you're day trading and this means you're skipping 10 trades a day and taking 1, or swing trading and are now taking 1 a month instead of 10, this will benefit you as a trader. Discipline is everything, and this approach of stringency allows you to size up over time with confidence in the outcome. But make sure to honor the risk window. It's there to give you freedom whilst making sure you stay in the game. If you ever go past the max, you've lost your discipline and will likely suffer. The pros of this style are flexibility for high quality setups, disciplined variation with a structured window keeping you within set parameters, and that it reminds you to stick to trades that score between 9 and 10. The cons of this style are you have to have a good level of discipline to ensure you never go above the risk window. It requires an advanced level of analysis of the markets to truly determine the grading of the setups, and that there's potential for emotional influence. You may be on a winning streak and decide to max out on a setup that isn't really 10 out of 10 out of false confidence, or on the flip side, size in too small to a top tier setup as a result of battered confidence from a losing streak. The style you end up choosing is up to you. Generally speaking, the first two examples are the go-tos for beginner traders. They keep you within good parameters to ensure survival, whilst letting you practice your discipline. The third example, on the other hand, is more beneficial for experienced traders, allowing them to leverage their skill set and maximize on market potential. All that being said, risk management is of course just one element of trading, and there's much more that you need to master. But fear not. I've put together a template for you that, no matter what level of experience, paves out the quickest route to profitability, saving you thousands of potentially wasted hours and allowing you to fast track your journey to success in just 8 simple stages. So click here and get going. I guarantee you will not regret it.